Welcome to the Balance Blueprints podcast, where we discuss the optimal techniques for finances and health, and then break it down to create an individualized and balanced plan. I'm your host, Justin Gaines, here with my co-host, John Proprie. In this episode, John and I discuss John's specific situation about launching a business and hopefully some takeaways for your situation if you're looking to launch a business. We have a fun episode ahead for you, but first, a quick disclaimer. John and I discuss his specific situation, and in doing so, there's certain nuances that aren't discussed in the episode that I'm aware of, and also specific considerations that I'm making on the fly. This episode's for education purpose only. For your specific situation, you should talk with the respective professionals or reach out to us to have a specific conversation. We hope you enjoy the episode.
I want to ask you these questions because from an unbiased business standpoint, we can kind of go through stuff. I'll tell you what I've done, how much money I've had, the things we got to do. We can see basically by the end of it, I just want to see if it's reasonable. If it's like something, sure, like take the jump, it might be a good risk, or if it's really just I need more money.
Right.
Basically something like that. So
yeah, we can talk through it. Restaurants are always tricky because they're high, no matter how good the numbers look, it's going to be a high risk venture.
Yeah. And that's all I want. Like you'll ask all your questions. I know you've done, and this is just, I guess, to pull it in because it's going to be very conversational. I want it to be somewhat applicable. But so this is all for a food truck. And I know you've done business plans, and it's always been something you've wanted to like fund at some point in your life. So you know, obviously the ways around it, what it would take. So I would be funding basically all of it, and it wouldn't be 50-50. So she thought of like 70-30 or, once she worked up, whatever. Yeah.
So the other thing you'd want to do is you'd want to structure it where your initial investment's a loan to the business. That way, all of your money, no matter what the equity splits are, the money that you're putting in is being returned back to you.
Mm-hmm.
And then that's also going to level the playing field a little bit because she doesn't have any money to put into it. You put in a loan, interest bearing at the federal minimum interest rate required, because for IRS purposes, tax purposes, there is a federal minimum interest rate, which you can Google. You can pull that up. It fluctuates, I think monthly, maybe quarterly. Mm-hmm. But you can find out what that is. It's usually pretty low. I think last time I looked at it, depends on the length of the loan, but last time I looked at it, I think it was around like 3.5%, 4%.
Okay.
Maybe lower now. Interest rates are coming down. So,
mm-hmm.
But that way you have it so that money's going to get kicked back to you, and the equity split doesn't have to play so much into consideration on how much money's put into there.
Okay. All right. So let's go deeper. I only want to switch this around because I feel like that's more of a middle part. So I'm going to switch this a lot. We got kind of the nice intro explaining to, I guess the first thing, we can even dive into that more. So the first thing is, my question, I guess, would be, so how do we go about that? Through a contract? I'm loaning her the money. I'm loaning both of us the money.
You're loaning the business the money. So you're going to create the business entity.
So we do have an LLC and an EIN.
Okay.
That's it.
An LLC, and you have a tax ID for that. So that's good. So you have the entity. Now you'll have to create an operating agreement for that entity so that the operating agreement is going to outline your ownership breakdown.
Mm-hmm.
Both sign that, have a contract outlining your ownership agreement. The other thing that I would do is have a contract outlining, technically it's like a buy-sell agreement, but have a contract outlining if somebody wants out of the business, how does that happen? What does that look like? Clearly outline your dispute and resolution clauses, how you're going to handle disputes, how you're going to handle resolutions. Ideally, you would go to a lawyer and have it drafted up, mm-hmm. just to make sure it's bulletproof. But if not, you can Google standard forms. I could send you some of the stuff that I've had from prior businesses. So the LLC will then have a loan payable, note payable to you, and you'll be the note holder. So you'll hold the loan will be to the business.
Like, are we joint? Is the contract for dividing up the LLC, or is it dividing up the business? Or are they kind of the same thing? Like if the LLC owns the business, do we have to be, does the partnership?
LLC is the business.
Okay.
The LLC is the business.
Okay. I get confused because like with the food truck, we need an LLC, but then we need like a business license as well. So
right. And the LLC will be the business license holder. Think of an LLC as a clone of you. Like it takes you, it duplicates you. The duplication of you is the business. Okay, so if you did a DBA, you would be the business, which just means you hold all the risk, you hold all the liability, you're exposed. So the LLC allows you to create a clone of you that is the business.
Okay. So when it asks for personal information, you're really putting in like the LLC's information and stuff.
Correct. Okay. And then that way, like if you're getting loans, signing up for credit cards, any of that sort of stuff, since you're going to be a startup, zero revenue, they're going to ask for a guarantor on those types of things. And that's where you personally, if you're the guarantor, you personally are guaranteeing that that loan or that credit card or whatever the obligation is will be paid.
Mm-hmm. So that's tied to like my name or her name.
Right. Yeah. Whoever's the guarantor, like you're going to put your social, you're going to put everything in there, all your personal information. You're guaranteeing that that debt will be paid if you go that route. What you'd be doing here is making yourself the note holder and loaning the money to the business. Because we want to think about it as the business has its own balance sheet. Mm-hmm. If you just put the money in without any loan, you just put in cash. So say you put in $30,000 into it. There's $30,000 in cash, which is an asset. There's no liability because you didn't do a note. So now there's $30,000 in equity that's now being split with whatever ownership agreement you put between the two of you. So if it's 70-30 split, you just gave her 30% of $30,000, so $9,000 for nothing. If you put a loan in there, a note payable, $30,000 asset, $30,000 liability, equity is zero.
Okay.
And then if you ever were to sell the business, say 10 years down the road, say that you were making a little bit of profit, but not a ton, you would be able to then sell that, and you'll have your client list, your relationships, your goodwill, all of that sort of stuff. You can sell the business. Say the business sells for $100,000, but you still have this $30,000 loan because you haven't paid it back. You would then take the $100,000 from the sale, pay back the loan, $30,000. You have $70,000 left to split between the two of you. And in that situation, if it's a 70-30 split, she gets 21, you get the remainder, and then you go your merry way. But the loan allows you to protect your investment into the business. It's not so much there because you're looking to get loan payments and looking to pay that off. It's there to make sure that in the event of a dissolution, a sale, any of that sort of stuff, you have it clearly earmarked what your investment is, and you're not just giving free equity to your partners.
Sure.
As a result.
That makes sense. All right. So I'll think of myself as her and I are the LLC, which is a person, and I personally am kind of like the bank doing a loan.
Correct. Yeah.
Okay. In my mind terms.
Yeah, that works. And actually, this is like great timing because I actually have to have this conversation with one of my clients at 4 today.
That's kind of nice. So you're priming up for it.
It's a sale of a business, and they called me up and said, can you help me? Can you help me with the insurance? And I'm going to have the DBA later today. And I was like, whoa, time out. Why are you getting a DBA? We're not doing that. We're going to sit down. We're going to talk entity structure. We're going to talk about this because DBAs are garbage. DBAs are nothing. Doing business as, it means...
is that like the personal one?
Right. So like that's why like we've talked about this enough so you knew to go get an LLC first. But a lot of people, what they'll do is they'll just go get a DBA, doing business as, which just says, I, John Proprie, am doing business as this name, and allows you to put that name, allows you to advertise with the name, put the name on, mailing addresses, bills, contracts, that sort of stuff. Doesn't give you any protection, doesn't do anything. This whole setup, you wouldn't be able to do, like you can't do a partnership agreement with a DBA. You need some sort of other entity structure in order to do it. I suppose you could do it with a DBA, but it would get very messy very quickly. You want to have a separate entity, which is what you have here, because you're going to have an LLC that's a partnership, so it'll be taxed as a partnership. Because the other, like the next jump, because this is probably one of your questions, so I'm just going to bleed right into it. The next thing here is, I know we're talking 70-30 split, but you're the one putting in the initial investment. Yes, you're going to protect that with a loan. But the other thing is you are still taking on the risk because there's no guarantee that that loan gets paid back because there's no revenue. So you had already mentioned that she's going to earn her equity through marketing and through hours on the truck. What I would do is I would create a vesting schedule where you know what split you want to get to. So if it's 70-30 and you want to maintain 70%, she wants to get to 30, you're going to want to create a vesting schedule where based on the number of hours worked, she'll gain a percentage of ownership up to a max of 30%, which is the point at which she's fully vested. And you just need to create that schedule so that it's clearly outlined. Mm-hmm. The reason I would do it on an hourly basis is it'll force the two of you to track her hours. And then in the event of a lawsuit contesting the ownership here, you will have a clearly outlined agreement that's vested based off hours worked, and also an outline and a chart that you've both agreed to and signed, mm-hmm. keeping track of all of the hours that have been worked. Because when I've seen partnerships like this go down and end up in, either a lawsuit or sitting there in arbitration trying to figure it all out, it's an argument over how much work was put in, where the balance is. So if you do this all ahead of time and you have it clearly outlined, clearly signed, documented, you're not going to have any issues. Mm-hmm. My recommendation is always to get a lawyer. However, if you want to cut back on that cost, the way to prevent yourself from having it go terribly wrong is to have as much documentation as possible. And as you know, I've been in a situation where I've had to fight that and didn't have a lawyer. And so I'm telling you partly from situations where this is what I wish I had done. And then also that arbitration went favorably towards me. And it was because we had enough documentation there. But some of that documentation was gathered very last minute through conversations, phone recordings, text messages, and me knowing what I was doing to gather that information. You're much better off doing it from the beginning, because the other thing you're avoiding by doing it in the beginning is nobody's under duress. So you'll be able to maintain those contracts and those agreements, whereas trying to run around last minute and get it through phone call conversations and text messages, the argument is going to be, oh, I said that and I was upset. I didn't actually mean it. I didn't understand. I didn't.
That's a good point.
Under duress. And that's a legal term. Under duress is a legal term. And then a lot of it gets thrown out. I'd say from the stuff that I gathered together, probably 80% of it got tossed, even though it supported everything that we already had from federal documents and in writing and not under duress. But simply because it's technically considered under duress, it gets thrown out and it isn't considered at all. So you want to have it documented as well as possible in the beginning, preferably with a lawyer. If not, make sure you write down everything and have me look at it, have somebody look at it that has experience going through it, so that you can make sure that there's certain clauses, because there's going to be certain clauses that you just don't think about that a lawyer would throw in there. And then that way you just make sure you just put in that clause.
Yeah. All right. So what I'm hearing, obviously very good tips. It's crazy how things can be twisted, but most important things to protect ourselves is over document. You can never have enough documents, especially when it's with someone you know. I feel like we're talking about starting a business in my case, but a lot of people do this. It's very easy, I think, to let things slide of oh, we're friends. Oh, that won't happen. So it doesn't matter. You should always do that. And then,
well, the other thing I would tell you is, if you get the gut feeling of we probably should talk about this, but I think if we don't talk about it, it might play out in my favor long term, talk about it. Yeah. You need to talk about it. Because I can tell you with my situation, there was definitely gut feelings where I was like, we should really talk about this.
That's a good point too.
I don't have any exposure on this. It's really just their exposure. They should be concerned about it. They're not bringing it up. I'm not going to talk about it. And now it's a contentious point that we're having to go back and forth on, where if you just act on that gut feeling, if you have more conversations, you're going to be better off. If you have more stuff in writing, you're going to be better off. Make sure everything's signed. And honestly, I would go and have, typically you can go to a bank and they'll allow you to sign as a notary public, and it doesn't cost you anything. So even if it costs you $20, $30 to have a notary sign off that you two are the ones who signed the documents, do it. Make sure have your documents notarized. Have it clearly outlined that yes, we signed, and yes, it was us who signed, and there's a third party here. Because if you're not going to use a lawyer, at least a notary public makes it so there's some sort of formal process where it was verified and it wasn't. You eliminate the comments of, oh, I was drunk when I signed that, so I was inebriated. I wasn't in a sound mind. I couldn't have possibly agreed to that. Doing these sorts of things just allows for you to protect yourself as much as possible. Because if you go to a lawyer, it's going to be notarized.
Yeah. All right. Great tips there. And then LLC. So we've covered those two things. Protect yourself through that. All right. So next things then. So that's all feasible. That's all doable. I want to, bring us back to the point of financials, time, and is this possible for my situation? So I'm just going to pull up a couple things here that I've kind of outlined and gathered that need to be done. All right, I'll pull this up, but actually we'll first go over financials, and because that's what all this is going to play into. We're going to talk about the prices of everything and everything I need done. So
yeah, so I mean, from a financial perspective, I always back into this. So if you're making the decision to do it or not do it, I always back into it. So what's the minimum amount of profit that you need to generate from the business in order for it to sustain you?
Mm-hmm.
Do you know that number?
So what you're asking is the money that needs to be made back to cover everything put in and a year's, quote unquote, year's salary?
Yeah. Well,
okay.
So the year's salary part.
Just the year's salary. Okay.
Yeah.
Well, $2,000 a month, we'll say.
All right. So $24,000 of.
Ideally, we can round it maybe to 30, just because that was probably scraping by, I guess.
Yeah. Okay. That makes sense. So 30,000 profit line. You said you're doing a food truck?
Yeah.
So this is why I kind of back into it. So if you just take national averages, it says food truck net profit margin. Net profit margin on a food truck is generally between 7 and 8%. Mm-hmm. If it's extremely successful, it could get, it could double that number, 14 to 15. Mm-hmm. So in the beginning, naturally, it's not going to be that high. If you took your 30,000, then average payroll cost is 25%. So divide that 30,000 by 25%, 0.25, and then divide that by 0.7 because you're only 70% owner. It's 171. And I would say those numbers are probably slightly aggressive. So if you jump that number to 200,000 sales, there wouldn't be any profit to share, but you'd be able to pay yourself as an employee out of the business. So effectively, because you're not paying yourself as an employee, it would just trickle down to profits and be shared. But you want to remember that it's a payroll expense because you're not paying yourselves anything.
Right. So kind of bypassing that payroll expense to start.
Yeah, if you eliminate the payroll expense, which from a quick search is roughly 25% of sales, mm-hmm. and just dropping that 25% down into the profit line, then you could do it at about 200,000 in sales.
All right.
So you're in the Northeast though, so you're operating.
Yeah.
8 months out of the year.
Yeah, that's generous.
We'll call it 7 months, depending on the weather. So you got to do 28, 29. So you got to call it 30,000 a month.
Okay, so to start, let's, I guess, go with the idea, if you agree with this, because we're talking about, is it feasible, is it possible? And we're going to get into how much money I have, and we'll obviously base it off that. We'll assume it's going to break even and not really pay me what I want for at least the first year we do it, or 6 months.
Okay.
That sounds fair, right? I mean, because we're not going to have a line the second we open.
Yeah, generally speaking, businesses typically don't, hit a profit line until year 3. So, you're still being aggressive by only waiting a year.
Okay, so if we use the year 3 line, are people working second jobs? Are they living off what they've saved up? What normally happens there? Because I imagine that being like my full-time job where I'm in that.
So the year 3 mark is a profit line number. So if you're paying yourself, like if you're one of the employees, you probably could hit it quicker.
Mm-hmm.
So I realize that kind of sounds like I'm backtracking, but I'm just, we're doing this live, so I'm turning while we're live thinking here. But so to answer your question directly, generally speaking, a business is going to either have the cash or take out a business loan, and that's going to cover 6 to 8 months of the operating expense, and then the hope is that gets you running, and then you're able to continue to run those numbers and cover your payroll. You're just breaking even, and you're moving money the whole time. I guess we need to back up a little bit is the issue. So typically with a food truck, you need permitting in order to have a location.
Mm-hmm.
So the question then becomes, do you have permitting? Do you have relationships with food trucks? How frequently are you going to be open? Because that's what's going to drive it. We're talking 250 transactions at a $15 average, which our number, honestly, that $15 average, we're pulling that number out of thin air too. Is that going to be the average ticket size? I don't know. We kind of need to look at a menu as well, see what the pricing is, see what the costs are,
mm-hmm.
build that out, and then what's our average ticket price,
mm-hmm.
with keeping your food costs, at 40%. So whatever your food cost adds up to, divide that number by 0.4, that's your sale price.
Right.
And that's going to get you your average ticket. Then it's going to tell us how many transactions we need to hit the $30,000 a month sale
mm-hmm.
number. And then if we hit that $30,000 a month sale number, how many days do we need to be open?
Mm-hmm.
Or doing it the opposite way, how many days are we open? How many transactions do we need to hit that? Without knowing what relationships you'll have as far as farmers markets, locations to be constantly open at, it's hard to say. It's hard to say if what your frequency is going to be. Now you can get away from the permitting thing. The permitting is if you want to be on state municipality land or public parking, that sort of stuff. You partner up with a business, a restaurant that owns their parking lot, a business that owns their parking lot. You can get a relationship that way, mm-hmm. where you're parked in a parking lot consistently and you have your food truck open there, because that's another option for you.
So what we looked at was the permit for like street parking in the city and other locations was about $1,000, I think, a year. But I imagine no spot, unless it's like our public market on Saturday or a different market on Sunday, unless we get into those, none of them are going to be super high, heavy traffic.
Right. But that's the beauty of a food truck, is that
you
are able to go where the traffic is.
Definitely. Okay. So that's good. Yeah, that's good to know. I've looked at all the permits. That's one. Business license, fire safety, 2 health department ones. I've probably added them up, and I was just being generous. I figured all of that would probably add up to about like $1,500 to $2,000.
I would imagine you're probably at the $2,000 mark pretty easily.
Okay.
And then you're also going to need in order to get some of those health inspections, you're going to need a relationship with a commercial kitchen typically.
Yeah.
You'll have to be renting commercial kitchen space.
Mm-hmm. Okay, so all that mixed with, so let's say $2,000 renting commercial space each month. Let's just bring it all up to, I did look here, it wasn't too much, but I think there still it was something like around $50 an hour. I don't think it was terrible. But so that will add up to about $200 a month, we were saying. So $2,000, $200, and then I was looking at trucks on Facebook Marketplace because I'm trying to save a little money. And generally, I feel like I could find one for $20,000.
Trailer or truck?
Truck.
Wow.
Yeah. So there's one in Utica that is around there. It's very small. There's a couple, there's a lot in the south that my dad was sending me. So I don't know how feasible that is, but I think there's fines. It's not like they're readily available, but there's a couple fines that if I went for, the distance, I could get them. But ideally, I'll say, because we're going to have to wrap it, we're going to have to make some changes, make it our own. So ideally, the truck would probably be 25 in total. Now, I think that's where I'm at. I think I told you everything. So I guess what we're at now is with those numbers, with my plan, with everything I've told you and everything I need to do, how long would you think it would take? How much money would you do to start it? And I guess that's basically it. Because once I have that, we can then look at my current situation and be like, that's probably not feasible, or it is.
Because this is where you're getting into when I talk about looking at businesses and I need to see 2, preferably 3 financial statements. Because what we're talking about here is balance sheet and cash flow statement. We're going to talk about income statement, which is what we were talking about when we were figuring out your profit line. But the income statement really doesn't matter if the cash flow sucks.
Mm-hmm.
And the cash flow you can get from different areas other than just your operating. One of the ways you can generate cash flow is through a loan. So instead of you spending $25,000 of cash, you get a loan that brings $25,000 of cash in, and then you just have a monthly expense that's going out. So you have a cash flow expense, you have a business expense on your income statement, but your balance sheet is unadjusted because you had asset brought in and a liability brought in instead of just reallocating cash into a different asset class.
Yeah.
Because if you buy the truck, you own it outright, your level of sales decreases in order for you to get your $30,000 of income because you own the vehicle, you have a lower cash reserve, but you don't have an expense item associated with it. You don't have an ongoing monthly expense item associated with it. There's not continual cash flow going out.
Right. Say I have $25,000 right now to my name. We'll just round it there. And that's actually what it takes to live for a full year. If I did no work or anything, I'd burn through all that money in a year.
Okay.
Assuming this makes not enough money to even pay me for a year, I imagine I shouldn't really touch or use any of that money to go towards the business.
Correct. To be in a strong financial position, you'd want to have, a year's worth of cash reserves that you don't have to touch. That you could not work, and it wouldn't matter. You'd have no income, and it doesn't matter. And then the remainder to fund the operations of the business would come from somewhere else.
Yeah, so that would be the loan.
Well, and you would need a loan for the truck, and you'd need whatever to get the licensing, to get your initial ingredients buy so that you can be open the first time.
And ideally, I plan to get the loan for the truck and then use my money for the rest. Thanks. So
if I were in your shoes, based off the quick numbers that we threw together, I would want $40,000 to do this.
Okay. That's fair. That's
if
helpful.
It's going to take $25,000 to buy the truck, get the licensing. For $25,000, you can open the doors, but you don't have anything in the grocery. You don't have any groceries, you don't have any food, you don't have any of that sort of stuff. I would want another $15,000 sitting there to buy groceries, to buy the the tools and stuff that I need, because stuff's going to go sideways. You're going to need to buy stuff. You're going to need to buy signage, marketing, all that sort of stuff. So if you had another 15, you're not going to be super duper stressed about it, and you're going to be able to make it happen.
It's pretty interesting because when I wanted to do this podcast with you, basically I was trying to figure out if I can do it before doing all this stuff. And really what we're kind of saying is you have to do all this stuff to figure out if you can even do it.
Well, part of the reason why I have so many business plans in my hard drives on my computers, and I say that plural because I'm a crazy person and don't throw out hard drives and they're all in a safe. I'll throw out a computer, but I won't throw out the hard drive. Literally take it apart and keep it. But the reason I have all of those is because you have to do this. And then you find out, that's not a good idea. Or it's not going to make me enough money, or whatever the case may be, or it's not the right time to do it. And so I hold on to them for that. But yes, you have to run this all through and put yourself in the mindset, am I doing this? Because if you don't get excited and you are stressed out just by running the calculations, that's your gut feeling telling you that it's not a good idea. Because the one thing I can tell you with starting a business, especially from scratch, is it's not easy. It's going to be tough. It's going to be hard. It's going to be stressful. And so if you're not excited just by running the numbers and doing all the hypotheticals, you're probably best off not pursuing it.
Thanks for listening to our podcast.
We hope this helps you on your balance freedom journey.
Please share your thoughts in the comments section below.
Until next time, stay balanced.